Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from the New Zealand Herald on the 17th of September, mortgage rate battle continues as Kiwibank cuts home loan rates. Topic number two from Oneroof on the 18th of September, Tony Alexander, why do houses cost 9 times the average income? Topic number three from NZ Advisor on the 18th of September, Kiwis' growing obsession with dream scrolling. Topic number four from Oneroof on the 17th of September, vibrations damage homeowners' property and the insurer is ignoring the claim. Topic number five from One News on the 19th of September, property sales slowly rising heading into spring, CoreLogic. So first up for this week in review from the New Zealand Herald on the 17th of September, mortgage rate battle continues as Kiwibank cuts home loan rates. The competition among retail banks over interest rates has intensified, with Kiwibank reducing both fixed home loan and deposit rates in response to falling wholesale rates. This move follows similar cuts by ANZ, New Zealand's largest lender. Kiwibank is now offering a market-leading one-year fixed mortgage rate of 6.29%, and it has reduced rates by 4 to 20 basis points across various terms. Deposit rates have also been lowered by 10 to 30 basis points. These rate cuts mirror trends in New Zealand and global financial markets, where slowing inflation has prompted central banks to lower their benchmark rates. The financial world is closely watching the US Federal Reserve decision this week, with expectations of a rate cut to counter a potential economic slowdown. Analysts are debating whether the Fed will reduce by 25 basis points or take a more aggressive 50-point approach. In New Zealand, the 6-month fixed mortgage rate has gained popularity among borrowers as many anticipate further rate cuts. And I suspect that that is going to be a good decision for those people who are choosing 6-month mortgage rates. Investors are predicting that the Reserve Bank of New Zealand, the RBNZ, will reduce the official cash rate by 87 basis points to 4.35% by year end. However, ASB senior economist Kim Mundy believes that this forecast might be overly optimistic, suggesting that the timing and scale of rate cuts will depend on the country's economic and inflation outlook. The next Reserve Bank rate review is scheduled for early October, which will be a week before the inflation data comes out again. This dynamic reflects New Zealand's broader economic environment, where housing and lending rates are sensitive to both domestic factors and global market shifts. Topic number two from Oneroof on the 18th of September, Tony Alexander, why do Kiwi houses cost 9 times the average income? This analysis is provided by independent economist Tony Alexander. The housing market of the 1980s and 1990s is no longer a useful comparison for understanding today's conditions. A common question is, why is the New Zealand dollar remaining strong against the Australian dollar, hovering around 91.5 cents compared to the low 80-cent range of earlier years? Historically, from 1985, when the currency was floated, to 2013, the average exchange rate was 82 cents, with lows of 73 cents in 2011, 76 cents in 2000, and 71 cents in 1992. However, since 2013, the average rate has risen to over 93 cents, peaking just above parity in 2020. This recent period provides a more relevant frame of reference. Similarly, mortgage rates today also differ significantly from earlier decades. Although a one-year fixed mortgage rate of 7.4% recently caused economic pain, rates below 10% were unthinkable for first home buyers in the 1980s. However, back then, house prices averaged 3 times the median income, whereas they now stand at around 7 to 9 times income. This highlights how past conditions don't offer a meaningful lens for interpreting today's housing market. Several factors have contributed to the rising house price to income ratio. Lower inflation from 1992 led to falling interest rates, enabling people to bid more for properties. Construction costs have soared due to stricter health, safety and building requirements, along with councils imposing additional fees. Land scarcity in cities like Auckland, Wellington, Christchurch, and Dunedin, with no new urban centres emerging, has also driven up land prices. Furthermore, housing has become a favoured retirement investment, with investors able to borrow and leverage their property investments in ways not available for other assets like shares. An entire industry has since emerged around property investment education, including ourselves, which we started Property Apprentice in 2010. Additionally, changes in immigration policies in the late 1980s increased demand for housing without a corresponding rise in supply. Longer life expectancy has also reduced the number of older houses hitting the market. Looking ahead, while it's unlikely that the house price to income ratio will climb till 12, a return to a ratio of 3 is equally improbable. The structural decline in interest rates is over, and government policies aimed at increasing housing density and land availability, along with higher construction rates, will have an influence on the market. However, a drastic reduction in the ratio is not expected. I think it's also interesting to point out that, years ago, certainly when we purchased our first property, the rules around lending were totally different at that point too. I remember there were maximum loan terms of 20 years, whereas now you can get up to 30-year loan terms. Also, you didn't have to prove your income, whereas now you do have to prove your income to the lenders ever since the global financial crisis. So bank lending has become a lot more responsible in the years following the GFC. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as an experienced investor and also a financial advisor. These events are available live online or in person at our office in Ellerslie. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no obligation phone call or meeting with my husband, Paul Roberts, via the website. Third topic for this week in review from New Zealand Advisor on the 18th of September, Kiwis' growing obsession with dream scrolling. A recent survey by Trade Me Property revealed that 95% of Kiwis still aspire to own their own home, despite current economic challenges. However, it's not just serious buyers browsing listings. Many are engaging in what they're calling dream scrolling, where they look at properties with no intention of purchasing. To be fair, I suspect people have always done that. On Trade Me, I know tenants often look at homes that they'd love to buy at some stage. Our teenage daughter, for example, she's looking to see how much properties are to purchase, even though she might be a little while away from being able to do that herself yet. And I think it's great. It's inspiring for people to look at properties that they might one day hopefully end up buying. Gavin Lloyd, Trade Me Properties customer director, explained that dream scrolling captures the what if mentality, and it's become a popular escape, particularly among younger Kiwis like my daughter. While most browse for practical reasons like checking sale prices, nearly half do it for emotional reasons such as inspiration or simply for enjoyment. The survey also uncovered some interesting habits, with 20% of respondents admitting to browsing property listings during work hours and 12% even doing so while they're on the toilet. Ew. Additionally, 38% of Kiwis prefer scrolling through property listings over watching rugby, and 12% favour it over sex. I'm not even going to comment. The survey highlighted a nosy side, with 31% of respondents checking out friends' homes online and a similar number looking at their neighbours' properties. Many also admitted to browsing homes far beyond their budget, feeding into the dream scrolling trend. Despite the fun aspect of browsing, home ownership remains a primary goal for most Kiwis, and Lloyd emphasised that even with economic hurdles, owning a home continues to be a key aspiration for many in New Zealand. I would 100% agree with that. I think it's a goal that everyone should work towards, because if you don't own your own home in retirement, it's going to be very expensive and you'll be faced with rents which are constantly on the increase. along with inflation over the long term. So the sooner you purchase a home, the more rosy your retirement is going to look. Topic number 4 from Oneroof on the 17th of September. Vibrations damage homeowners' property and the insurer is ignoring the claim. A South Island homeowner discovered that his insurance didn't cover damage from vibrations caused by nearby construction. This highlights the importance of understanding not just what is covered by insurance, but also what's excluded. According to Karen Stevens, insurance ombudsman, many people are surprised to find that their insurance policies exclude certain types of damage, such as that from vibrations. She advises thoroughly reviewing insurance policies and asking detailed questions to fully understand the coverage and exclusions before signing. The affected homeowner noticed cracks in his lounge after construction work began next door. His insurer confirmed that while he was covered for earthquake damage, vibrations from the neighbouring development were not covered. I mean, that's just ridiculous, in my opinion. The Insurance Council of New Zealand indicated that damage from earth movements or vibrations is typically excluded from standard house insurance policies, but they cover for earthquakes? The homeowner is advised to contact the contractor or developer to discuss measures to minimise the risk and check if the developer has liability insurance for potential damage. It's also recommended to document the condition of the property before construction begins to make proving any damage easier. Lawyer Carl Robinson emphasised that insurance policies often exclude coverage for high risk or unpredictable events, such as damage from vibrations. He noted that policies typically cover accidental or unforeseen damage, but exclude certain causes like terrorism or war. Joanna Pidgeon, another lawyer, suggested obtaining a pre-dilapidation report to record the property's condition before construction starts. This can help in proving whether damage is related to the construction work. For those unable to afford such a report, taking dated photos and videos is a cost-effective alternative. Adina Thorne from Thorne Law noted that while she's handled cases involving vibration damage, the results can vary. She advocates for clearer insurance policies and mandatory insurance for developers to better protect homeowners. The Insurance Council's website outlines common exclusions in house insurance, including damage from insects, wear and tear, and intentional damage. Homeowners should be aware of these exclusions and consider additional coverage if needed. My advice would be to talk to an insurance advisor before you take out any insurance policies for whatever you're looking at insuring, and just make sure that you understand all of the implications involved. Topic number 5 from One News on the 19th of September. Property sales slowly rising heading into spring, according to CoreLogic. Property sales are showing an upward trend, but volumes remain below typical levels as the spring selling season approaches, according to CoreLogic. Sales volumes, including both private and agent-led transactions, increased by a whopping 1.6% in August compared to the same time last year. I'm sure you heard the sarcasm in my voice there. However, the total number of sales, 6,320, was about 15% lower than the 10-year average for August, so we're still on very low levels. CoreLogic economists noted that while new listings are steady, lower sales levels have led to growing number of properties on the market. Chief property economist Calvin Davidson attributed this to cautious buyer behaviour, despite lower mortgage rates boosting sentiment. He explained that job insecurity is dampening buyer confidence. Davidson observed that lower turnover has resulted in falling property values in some areas, which may benefit certain groups, particularly first-home buyers, while mortgage investors remain more hesitant. Regions like Wellington, Bay of Plenty, Auckland and Otago have seen stock increase by 20 to 25%, offering buyers more choices, which is great. He also suggested it'll take time for lower mortgage rates resulting from the Reserve Bank's recent cuts to have a significant impact on the market. While reduced rates may gradually increase buyer demand and create competition, he cautioned that high interest rates and existing fixed-rate mortgages could delay the effects. Davidson predicted another rate cut next month, likely reducing mortgage rates further, but warned that a new property boom is unlikely given current affordability challenges, high listings, and a weakening labour market. My thoughts on this are yes, the property market is increasing in activity, lots more listings available for sale. So that's keeping the property market relatively stable at the moment, even though there are some increased numbers of buyers. I personally don't see the property market really entering the next boom until the economy is much stronger than what we're currently seeing now. Learn how to make the most out of current market conditions. Register for our How to Succeed with Property Investing event. In our free online and in person sessions, we teach you proven strategies so that you can make smart, informed decisions in today's market. Whether you're a seasoned investor or just getting started, this event is packed with practical tips to help you to achieve your financial goals. I'll also tell you more about how we help our clients to achieve their investing goals. So if you're interested in finding out more about what we do, go to propertyapprentice.co.nz today and sign up for our events. If you've already been to one of our free events and would like to know more about how we can help you on your journey, book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening.